Good morning. All the best for 2022. And I hope you all had a very good, enjoyable and relaxing break over the last 2 months. There is so much to cover today. February is the tax year end, and I've got a few slides at the end of today's presentation, just talking about how you can make the most of your tax allowances in terms of your tax-free savings account, retirement annuity, and others. We also have our China webinar this Thursday, so please keep a lookout for that. And lots to talk about in terms of last year, how the market did, and what we expect in 2022. So let's jump straight in. 2021. There may have been a lot to grumble about, but it certainly was a great year for your savings. Generally, everything did very well, and the Sygnia funds were very well positioned for how the markets turned out over last year. If you look at the light blue colors in the top, the bars there, you can see the worst performers, but still positive. Global bonds, SA cash, and Rand gold in Rands. And as you know, Sygnia funds did not have any global bonds and no gold, and we were underweight cash. So that all worked out very well for our portfolios. The outstanding performers of the year were industrial commodities. You can see copper here in the orange, and oil, the best performer at the bottom, 65%. That was a result of us moving back into a lockdown, losers becoming lockdown winners situation as growth recovered and the world started to normalize as lockdowns reduced and mobility increased. But generally, equity returns were phenomenal across various asset classes. MSCI All Country World Index, which is the proxy for your global assets, nearly 30% return. South African equities, over 20% return. So generally very good positive returns from a variety of indices, very good for savings. Looking specifically at our thematic long-term growth portfolios and how they did, they also had a very good year last year. So second best performer from the bottom, you can see there with nearly mid 45% return was the FANG Plus Index. That sits within our technology thematic satellite and had a very, very, very good year. As you all were aware, we were only invested in that in our portfolios for the first half of the year. We managed to get a good chunk of that return, but did sell out a bit too early. The second best performer was global property, which had also a phenomenal return, nearly 40% return in Rands in 2021. And that global real estate was one of the thematic satellites. We were overweight in our global portfolio, so we're very happy with that. Value, which is the third red line here, third from the bottom, also nearly 40% return. Value did incredibly well last year, better in the first quarter and the final quarter, but certainly had great returns as US interest rates started to rise. Above that is MSCI World Healthcare Index, which talks to our health thematic satellite. Again, a fantastic return ahead of the benchmark, or certainly the overall benchmark, which is the MSCI All Country World Index, which is just above that. So 4 of our satellites having a very decent benchmark beating return in 2021. There were 2 stand-up disappointments, unfortunately. Fourth Industrial Revolution, you can see here, which did nicely, did beat cash, beat South African bonds, beat Rand, dollar cash, but still not as well as other equity indices. This was as to be expected. Rising interest rates in the US is a headwind to growth stocks. But I've got another slide on this just so we can go into it in more detail. We still are firm believers in this portfolio and are looking to increase our allocation to the satellite. The worst performer for the year in terms of our thematic themes, our satellites, was emerging markets. Emerging markets, fortunately, still beat gold and dollar bonds and Rand cash, but it was dragged down by China. We only invested directly in China after the fall, towards the end of last year. So we did better than the overall index, but in general, EM was pulled down by China. EM ex-China actually did quite well, had an above average year, but China struggled. And we all know the issues that were around China. It's particularly the tech regulations, which caught markets by surprise, and the property defaults that are happening there. We still are very positive on emerging markets, and China in particular. We are also looking to top up that position. So if any of you want to find out why it's a great time to be investing in China right now, while this is certainly a once in a decade, if not once in a 2-decade opportunity, listen out for the webinar on Thursday that Nikki's presenting. Great webinar, great background and insight to China, how the markets work, what drives it, how we're positioning in that environment, and why we think it's a good time to invest. So I do have a separate slide on emerging markets as usual, and I'll go into why we are bullish. I don't go into China into as much detail as Nikki will on Thursday. Unfortunately, January's been quite a market-moving month. So although 2021 was a great year for savings, January has been quite disruptive. We've already seen month-to-date January returns. We've seen Bitcoin down 25%. Maybe that's not too surprising. There's a lot of volatility in Bitcoin, but MSCI World is down 10% in rands. That's a very big drop for core part of our portfolio. NASDAQ is down 15% in rands. The good news is China is fortunately up this month, so it's finally starting to bounce back relative to the rest of the world. And more importantly, the Sygnia portfolios are doing very well. So my favorite, I know we shouldn't have favorites of our children, but we do. My favorite is the Skeleton Balance 70, and that fund is actually flat month to date. So even though MSCI World is down 10% in rands, NASDAQ is down 15%, that balanced fund with 70% equities is actually flat. And that's after a record-breaking December month, up 3%. So the funds look well positioned. They were well positioned in 2021. They look well positioned in 2022 to handle the volatility that we expect. And I'm going to take you through the 3 major risks that what the markets are aware of, that we've positioned the funds for. Obviously, the risks you don't know about, the black swans, that's what catches everyone by surprise. It's very difficult to protect against that. Besides looking at long-term valuations or putting in diversification, and we do our best. But certainly the known knowns we are well positioned against, and it's certainly reflecting well in our January performance numbers relative to the market. But sorry, I jumped into that. Before I get into those risks, I forgot, let's talk quickly about Fourth Industrial Revolution Fund. We are looking to top up this fund relatively soon. So one of the big themes that we were watching last year was the rise of US interest rates. And I'll talk more about that later on, but US interest rates are the cent, or US bonds are the central asset class for all pricing and all valuation of all assets in the world. They are vitally important, dollar-based and dollar funding. And when interest rates start to rise, well, it becomes more difficult more expensive to borrow money, and things that have cash flows that are further out start to hurt badly. So generally, when interest rates are falling, or interest rates are zero, it's very good for growth stocks, particularly good for innovation stocks. And when interest rates are very expensive, it's better for value stocks and deep value stocks because they're producing cash flows now. So we always expected there to be a bit of a headwind to tech stocks, particularly growth focused, and even then particularly the innovation stocks, which are almost hyper growth. They're very sensitive to interest rates, and US bond yields have risen quite aggressively last year and again in January. But despite that, it's still a fantastic portfolio to position for the long term. We remain in a long-term view as low growth, aging demographics and populations, too much debt, the QE, which has led to zombification of companies. There's a whole host of reasons why growth is going to be much lower going forward than it was in the past. And in a low growth, low return world, you do need to look at areas where market share gains can drive revenues. And Fourth Industrial Revolution is the backbone to that concept. And it's well diversified. There are over 500 stocks now. When it was initially started, it had just over 200, now over 500. In December, we added 2 new indices, the Digital Health Index, and that focuses on enabling remote medical patient monitoring and diagnostics, platforms providing or enabling remote clinical services, remote surgery, cloud-based solutions. It's a fantastic index. Also added the Smart Factories Index, which focuses on technology which empowers digitalizations of factories to improve manufacturing processes. both key indices that have been added, and the portfolio, as I said, is well diversified. So while it is struggling just through macro factors of rising interest rates, the growth is coming through very nicely in terms of earnings. The chart here just shows ARC Innovation Fund, which is one of the competitors to Fourth Industrial Revolution and has been around for a while and is available in South Africa. And just in terms of the importance of diversification. So the ARC Fund is very concentrated, and you can see ARC investors who bought at the peak have lost more than half of their money over the last year. Fourth Industrial Revolution in dollars and rands has done better, but in dollars it has had a tough time, but it's down about 15% from its peak. So the importance of diversification is vital when you're looking at these long-term growth themes, which are particularly exposed to volatility. Regardless, we shouldn't be looking at short-term performance. I mean, this is technologies that are going to change the lives of our children, and it's something that you buy and you hold for the long term. You're looking for long-term growth in earnings, and it will take time, and volatility is expected. So it's not something to be concerned about, short-term volatility, and we aren't. But we do think we're getting to an attractive entry point. There's a limit to how much US bonds can rise. There's a limit to the valuation concerns that are happening, and we are looking to, although we have a small overweight in this fund, we are looking to increase that relatively soon. Okay, but I'll get back to inflation and US bond yields as one of the three risks that we're talking about going forward. So in terms of risks for 2022, there are three big ones that we're worried about: geopolitical, US inflation, and COVID. The biggest, certainly at the moment, or the most concerned that we are, is geopolitical, in particular Russia. For Putin, the Ukraine is the last stand. Russia has amassed over 100,000 troops near the border, 5 times the number of tactical groups compared to 2014 when Russia seized Crimea. Now, Putin wants to make sure that Ukraine doesn't become a NATO member, and the negotiations that happened last week between Russia and the West ended in a dead end, according to Putin. And they're certainly looking for ways or excuses to invade. President Joe Biden has said that Russia would pay a heavy price if they were to invade, and certainly it could lead to a massive oil price shock. So one of the things markets don't like, economies don't like, is oil price shocks. And if we do see things start to escalate in the East, it could be a major problem for the world in terms of what happens to oil price. But in general, it's a problem for Eastern Europe right now, and Russia and the outlook for that region. So we're watching that quite closely, and we are trying to immunize our portfolios against that risk. But our base case remains that it is a risk, and it's a risk that hopefully is avoided. And our base case is that the world will continue to grow nicely in 2022. World Bank is expecting GDP growth of 4.1% in 2022. Company earnings remain strong. Financial conditions remain neutral. They're no longer positive. We've got global central banks raising rates now, but still in the very early days of tightening, which is generally quite positive for stocks. We know near being too tight in terms of financial conditions. So overall, a recession remains unlikely. And when there isn't a recession, you want to be long equities, long risk. That said, there are the three risks that I mentioned: geopolitical, oil price shock, and Russia is the one. The second is inflation. At the Fed and other central banks are forced to tighten too quickly. We don't see this as a major risk or high likelihood that will happen. Top right-hand chart explains why. The light purple line is the Baltic Dry Index, which is the cost of shipping, and that you can see is halved. So the cost of shipping is halved. That's very, very deflationary, very good for bringing the costs down. The darker purple line is the business supply delivery days. That's the number of days delay that businesses are exposed to in terms of receiving their deliveries. That has dropped from 79 days to 65 days. So again, showing that the the COVID impact on the supply chain seems to be improving. And when you're moving into this environment of improving supply chains, lower costs, at the moment, oil price seems to be well behaved. OPEC did increase the amount of oil production by 400,000 barrels a day, which is also helping. Provided oil remains well behaved, and OPEC is well below their optimal output, they could easily increase that supply quite significantly. And provided they do, and oil remains well behaved, inflation shouldn't be something that forces the Fed and other central banks to raise rates too quickly. The third risk is a deadlier COVID strain. And so we've just had Omicron, turned out to be very contagious, but fortunately a lot less lethal than the Delta variant. And it looks like it's providing partial immunity to the more lethal Delta variant. And certainly the tendency for viruses over time is for them to become less lethal. That's what happened in the Spanish flu. That's what seems to be what is happening here. And it is the way that it happens, because if viruses get more and more lethal, they eventually wipe out their host and wipe out themselves. And that's not something they want to do. So it doesn't mean that it's impossible to get a new deadlier COVID strain, but the high probability event is that Omicron remains, or an even less lethal version of COVID comes out. And this just sort of degenerates from a pandemic into an endemic and becomes another strain of flu. So it's still impacting the world now, but certainly we're learning to live with it, and it's likely to become less and less of an impact as we move forward. And South Africa seems to show that quite cleanly. We were the first region to talk about the Omicron variant. You can see here the very strong fourth wave in terms of number of cases. This bottom right-hand chart, look at the black line, shows the number of cases that peaked way above the first, second, and third waves, but the deaths seem to have peaked at a much lower level. Certainly hospital utilization is much lower. Number of people on ventilators was much lower, and the overall infrastructure levels weren't compromised, which means that lockdowns didn't have to happen. And we were all well aware of what happened this past festive season. There were a lot fewer constraints than there were over the previous one, which I'm sure everyone was very happy to see. So 3 big risks: Russia, geopolitical, the Fed and inflation, COVID and other strains, but generally not our base cases. Our base case is that equities continue to rise. Volatility remains high. Yes, returns won't be as good as last year. We had a fantastic year last year, but you want to remain overweight equities and underweight gold and developed market bonds and other risk-off assets. Looking in particular at the 2 largest economies in the world, the US and China. Starting off with the US, we see here Jeremy Powell talking a little bit about, or at least trying to talk the market down somewhat. So the Fed wants their cake and to eat it. So they want to keep interest rates low, but they want to avoid an asset bubble. So how do they do it? Well, they talk about raising rates. They talk about asset valuations being somewhat elevated to try and actually keep markets from going too high and becoming too exuberant. At the same time, they don't want to kill the economies. They don't want to raise interest rates too rapidly. They have, of course, unwound the taper. They've announced in November that they're doubling the pace of the taper unwind, so increasing the amount of bonds that are being reduced. So a reduction in the purchases each month, an increase in the reduction from 10 billion and 5 billion per month to 20 billion and 10 billion per month. Again, just huge numbers. It's difficult to fathom these changes. But they're still, fortunately, talking about just tapering. They are buying less bonds. So they are still buying bonds, and that's likely to happen until the middle of the year, when we'll see the first hike happen in the US. The ECB has followed this hawkish announcement, and they've also talked about ending their QE program, $2.1 trillion program this year. The BOE was the first major developed market central bank to hike rates. They hiked by 15 basis points in December, so it was a bit of a surprise. But generally, we're starting to see the early signs of tightening, of raising rates. And while this is a risk to markets, it's not a major risk, and we don't think that they're going to be forced to hike anytime too soon. But what it does do, it does mean that the rotation from growth to value is going to continue. So there are two things that cause that. The one is bond yields. Bond yields need to rise to acknowledge that growth is recovering. So the chart here on the top right, it shows the global PMI in black, which is basically how well economies are doing. A PMI 50 means that economy is at trend growth. A PMI above 50 means an economy is expanding. A PMI below 50 means economy is contracting. So when an economy is expanding like it is now, you can see the black line well above 50. Well, your real yields should also be positive. Over the long term, real yields are a proxy for GDP growth. So in the short term, they also tend to be quite correlated, but you can see how the big dispersion in this red circle where real yields right now are incredibly low relative to where real growth is. So the likelihood is that as growth continues to recover this year, that real yields will pick up. One of the reasons they have actually been so low is that inflation has been quite high. And because inflation has been so high, it's actually, and bond yields couldn't rise beyond a certain point because central banks were buying those bonds. Again, so QE was distorting how much bonds could go up. Inflation got very high. So the only thing that could move was real yields. But as inflation rolls over this year, real yields will rise. So even if we do nothing, even if growth stays where it is, as inflation rolls off, real yields will rise. It's just pure base effects, and we don't need to have any positive surprises that happen. So as those real yields rise in terms of base effects, well, then you move to the bottom right-hand chart, which shows value will outperform growth. And you can see here, already just in January, a strong rotation that's happened out of growth into value. And that's why we've seen the NASDAQ sell off. We've seen S&P 500 sell off this month. We've seen very strong returns from the value indices, which have been very positive, including China, and that's worked very well for our value satellites. We think there is further room for value to grow. As you can see, this just even looking back a year, the value growth relationship, there's still a lot of room, and there is still some room for US yields to continue to rise, and for value to catch up. As you all know, we invest directly into the MSCI Value ETF, which we don't offer as a thematic satellite because we think it's a short-term positioning. We do have a good alternative, which is our FTSE 100 ETF, and I'll talk to you more about that later when I get to the positioning slide. But overall, we still remain positive on growth. We don't think that rising interest rates will be a headwind to markets, certainly when they're being driven by strong growth. Rising interest rates, when they're in the early stages, when there's still loose monetary policy, when interest rates are just starting to rise, when it's being driven by strong growth and not inflation, well, that's a good time for markets. We do remain underweight the US. We're underweight S&P 500, and that's not because we don't like the US. The US is one of the most amazing market-friendly markets in the world. But when US interest rates start to rise, and again, it's quite paradoxical if you go back to your economic textbooks, when interest rates rise, that's when your currency is supposed to appreciate. But that's not what actually happens in reality. And certainly at the beginning phases of US interest rates rising, that's when the dollar tends to weaken. So one of the major reasons we're underweight the US, we do think the dollar will continue to weaken in 2022, which is good for the rest of the world, and particularly good for emerging markets. And so we remain underweight the US, overweight Europe, overweight Japan, overweight value. Looking at the other, potentially the largest economy in the world on a PPP basis, it's still all about common prosperity in China, but things are definitely looking up. It's been a tough 6 months in China. Markets haven't fallen in absolute terms, but they have definitely moved sideways and have lagged a bit until January when they picked up quite nicely. So top right-hand chart, what's looking positive, why we are excited about being invested in China. Well, China makes a third of EM, so if China is doing well, that's good for EM, and we remain overweight our EM satellite. But we're positive on our EM satellite because China looks good. Top right-hand chart here, the black line is the credit and fiscal impulse, and that tends to lead GDP and growth and markets in China. So that has turned quite nicely. The green line, which is the 12-month number, it looks like it's bottomed as well. So we are expecting markets and growth to follow this impulse. So that's a very positive forward-looking indicator. We also had some positive news. Chinese coal prices have collapsed. They've halved. So despite all the promises and efforts about ESG, China told 170 coal mines to increase supply. That was in December. And as a result of all that supply that's come online, coal prices have halved. And that means cheap power. That means that factories can resume production at much lower costs. And that's good for growth, that's good for employment, and that's good for the Chinese old economy. Now, we're not particularly bullish on the Chinese old economy, but in general, we're bullish on China, and when it gets that sort of support, well, that's good. Not only that, but Chinese exports in December reached record levels, and more importantly, China's central bank cut interest rates by 10 basis points. That's the first time in 2 years that the Chinese central bank has cut interest rates. So that's a very positive signal in terms of liquidity, in terms of China wanting to support growth. And you can see the bottom right-hand chart talks to valuations. This is the MSCI cyclically adjusted PE, so that's a long-term adjusted PE relative to MSCI all-country world index. And you can see that China is the cheapest it's been in a 20-year period to the world. And when we have such strong positive catalysts coming through, as we do right now, then that's a good time to get invested. Now, there are some risks that remain. Certainly, the defaults in the property sector haven't stopped, and there's still going to be some volatility associated with that. And the risk of tech regulations or more regulations coming through still exists. We believe that risk is vastly reduced. At the political meetings that happened in December, the focus very much this year was on growth, whereas last year the meeting was on reforms, and that was what led to all the reforms that happened in new regulations in this past year. That focus and the noise that's coming out seems to be now focused away from reforms and back to growth. So I think that risk is reduced. It's also interesting to look at the top 8 patent holders. So which countries hold the most patents in the world as at the end of 2021? And 6 of the top 8 holders are China. Korea is number 1, Samsung, it's at number 1. IBM is at number 8, that's in the US. But the other 6 in between, so 6 other top 8 companies in terms of patent holders are domiciled in China. So China is certainly punching above their weight in terms of R&D, in terms of their technology. It looks like a great entry point. It may not be the ultimate entry point. It may get a bit cheaper. Volatility is going to stay high. But we think that when the rest of the world is looking particularly expensive, that this is looking particularly attractive. And as I mentioned before, a weak dollar is positive for emerging markets, and certainly emerging market growth is starting to recover relative to DM growth. So as interest rates start to rise in DM, interest rates are now cut in China, well, that will see a bifurcation in the growth and a divergence of that growth, and that's very good for EM stocks relative to DM stocks. So generally, we remain overweight EM, still our biggest overweight in our satellite, done quite nicely month to date. And we expect it to continue to do well in 2022 as there's more weak dollar and more rising US interest rates. Focusing on South Africa, normally I can be at least balanced on South Africa and say, yes, there's some good news and there's some bad news. Unfortunately, over the last 2 months, at least the news that's come out, maybe on the ground things are getting better and things are happening. And if you look really hard, you can find some positive news. But the headlines certainly have not been phenomenal. The Zondo Commission report was handed over to President Ramaphosa. It's part one of a 3-part series. The president is only going to comment once all 3 parts come in. I'm not sure why it was handed out in 3 parts like this, but that's what happened. Anyway, there's some scathing comments in that report. The ANC did not care, or they slept on the job, or they had no clue what to do. I mean, that's just a terrifying thing to have said. The report further highlights that no prosecutions of a politically connected individual has been made as of yet. So despite talking about terrible corruption and 50 billion rand that has been lost, not a single prosecution has been made. So we'll wait in anticipation to see what the 2nd and 3rd reports say and what our president says as a result. But so far, just highlighting how bad things have been and from a corruption perspective. The World Economic Forum outlines South Africa's prolonged economic stagnation. So just talking about how long growth has been basically zero in South Africa. We just have no GDP growth. And they point to the highest unemployment rate in the world, which again is true, blaming and SOE collapse and the failure of public infrastructure, blaming it on illicit economic activity and corruption. And that's just a very disappointing thing to be highlighted. And hopefully most of this is looking back, and hopefully we're through the worst, and but it's still difficult when you see all this negative news coming through. Youth unemployment, a catastrophic 74.8%. That's from Investec, that's the expanded definition. Top right-hand chart is Bloomberg, that's the narrow definition and slightly lower. But still, when 3/4 of people between the age of 16 and 24 are unemployed, it makes a living wage almost inevitable. And there's talk of extending the social distress relief grant, and it may just be extended forever. And unfortunately, the problem is we can't afford it. It hasn't been budgeted for. I mean, our budget is very tight as it is. We're only starting to see any sort of convergence and reduction in debt many years out. We still double the EM average in terms of debt to GDP, and things are looking fragile on that side. And while we desperately do need something to look after a 75% unemployment rate, I'm not saying we don't need it, I'm saying we can't afford it. So what is it? What do you do? Your taxes can't be pushed any higher. We desperately need reforms. I mean, if talking about reforms, we've got a 75% unemployment rate, but we lost 50,000 work days to strikes in the first 9 months of 2021. Something is not working right when everyone's unemployed and everyone is striking. You need to create jobs. You need to create growth, and you can't do that when Eskom wants to increase its tariffs by 40% over the next 3 years, while saying that load shedding is going to continue for at least the next 2 years and likely to be as bad as last year, which is the worst we've had in the last 14 years. So you can't have a situation where electricity becomes almost unaffordable and is so volatile that no one wants to invest, no one wants to create jobs, no one wants to take on the risk of people striking. That it's just reforms are desperately needed, and they are clearly lacking. And we need to focus things on the right things. And certainly focusing on the public wage was the right thing to do. But again, that's already been, the wage settlements that have come through are 5%. They're way above what was budgeted for. We're looking at an extra 70 to 80 billion rand more than budgeted going to those wages. Ramaphosa is pushing ahead with land expropriation without compensation. We've seen that a census has been announced for this year. Now, censuses are good things. So I'm not saying it's not a good thing, but hopefully there was a misprint in the press. But they estimated a 20 billion rand budget for the census. That works out at paying each person that's going to work 3 weeks 170,000 rand. I don't don't know what's happening. SA Taxi has been set up a COVID relief fund. Now, COVID's pretty much done and dusted in South Africa. Now they've set up a 1.1 billion rand relief fund, which is going to pay every taxi owner a 5,000 rand cash settlement. We can't afford hospitals. We can't afford such important things. Reforms are desperately needed, but we seem to be spending money on things that don't make sense. So at some point, hopefully, the right decisions start to get made. But right now, the news is I don't understand the news that's coming through right now. It's hard to be positive right now. I completely acknowledge that. We are looking at incredibly cheap valuations. We remain overweight South African bonds. South African bonds are incredibly cheap throughout the world. I mean, we are some of the highest real yields in the world, and so we do overweight South African bonds relative to South African cash. But we are underweight South African equity relative to global equity, partly because of all the great growth opportunities and value opportunities and thematic satellite opportunities that we have globally, but also partly because you can't have growth when you've got no power, no employment, everyone's striking, a budget, no money in the budget, and most importantly, no reforms. I suppose that's what's most disappointing, is that everyone seems to know exactly what needs to happen, and everyone's in agreement with what needs to happen. It's not like there's any argument; it just doesn't get done. It's just frustrating. Anyway, so we remain underweight South African equities. They still are. So the irony is our two biggest underweights. We're underweight US equities, but that's still our biggest allocation in our global equity portfolio. We underweight South African equities, but it's still our biggest allocation in our overall equity portfolio. So it doesn't mean that there's not value and you mustn't own South African equities. It's just you look for a positive catalyst to go overweight, and we haven't seen a positive catalyst. In the US, the concern there is not a positive catalyst. The concern there is a weaker dollar, possibly some antitrust issues on the tech regulations, and just general valuation concerns. But we've still got a lot of South African equities. We've still got a lot of US equities. So despite being underweight those regions, we do need exposure to them. I think that's important to stress. So moving on to the last slide before I go into some tax issues. Just our general positioning, it hasn't changed since the last webinar. As I said, we are looking to increase our fourth industrial revolution exposure, this disruptive technologies. We are looking to increase that weight. It's looking like a more attractive entry point relative to other equities. So we might be selling some other equities to buy that. We still are very overweight emerging Asia, including China, which we bought towards the end of last year after it had fallen 50%. That's already well in the money, but we think that there's a bit more of a rally to come there, so we're not taking profits on that just yet. We remain overweight health as a key cornerstone of our growth thematic satellites. Yes, it did very well last year, but it continues to, it does well every year. Valuations are still reasonable. It's always a little bit expensive, but valuations are reasonable, and we like that. Value is doing incredibly well in January. There may only be another 6 to 12 months left of the value run, but we do think there's 6 to 12 months left. For anybody who is looking to take advantage of global value, the Sygnia FTSE 100 ETF is available. The FTSE 100 trades at a whopping 40% discount on a PE basis to the S&P 500. Nearly half the PE of the US that the UK trades on, which screams of value. It's also at a 20% discount to the Eurostoxx 50 ETF. It has only 1% exposure to technology, so it's immune to rising interest rates. And it has 40% exposure to sectors like financials, banks, materials, and energy, which make up the bulk of the value index. So it's got a very strong value. 40% of it is value. It's half the PE of the US. And if you don't like China and you want to stick with developed markets, it's a nice way to get exposure to value. We don't have that. If you're looking for that in your investment report, we don't have that in our balance funds because we go directly into the value ETFs, which we do hold on a short-term basis to get that value exposure. But it is a good proxy if you don't have exposure, access to those underlying ETFs in the global universe. Okay, so that's it for 2021. Was a great year. 2022 looks like it's going to be a good year. Volatility to continue, some risks, geopolitical, COVID, rising interest rates, but we think that the base case is GDP continues to grow. The Fed doesn't have to hike too soon. There's no new deadly strain of COVID. Putin doesn't invade Ukraine. Markets continue to go up, and you want to be overweight equities this year enjoying those gains. We prefer thematic satellites, particularly looking to get exposure. If you have cash flows are coming in, now's a good time to top up on 4th and China and emerging markets. Health is looking fairly valued. Value should have another continue on short-term bounce. Global real estate's starting to look a bit pricey, but we're holding on to that for now. But generally, things are looking stable into 2022 or positive into 2022. Now, how to take full advantage of your tax allowances. So 28th of February is the end of the tax year. You do have some allowances, and those allowances run out. So you've got just over 5 weeks to take advantage of that top up, and we believe it's a really good idea to do so. So this chart talks about 3 different tax investors. So they invested in the same underlying balance portfolio. The top one in the red is someone who's invested in that portfolio via tax-free savings account. The blue one is someone who invested directly into unit trust, but they held it for more than 3 years. They didn't take profits within a 3-year period, so any gains they had were treated as capital gains. And the light blue was invested directly and traded quite aggressively. So all their gains were seen as income. And you can see the massive impact that tax has. Underlying same fees, same investment portfolio, but without paying taxes, you get nearly double your savings than if you're paying income tax, and roughly a quarter more than if you're paying long-term tax. So your tax vehicle is very, very, very important, and it's vital you do use those allowances where you can. Now, unfortunately, there are some limits to those allowances, and there are some constraints to those allowances, and that's sort of this chart explains. And I have taken you, it's the same table that I took you through last January, so some of you have seen it, and for you it'll just be a refresher, but for those of you who haven't seen it, I'd just like to take you through the details. So reading across from left to right, you can either invest directly into a unit trust or an ETF or buy a share, whatever the product may be, or you can go into a variety of wrappers. Tax-free savings account is the next line, retirement annuity, endowment, or living annuity. So you either go direct into your unit trust, or you take one of the 4 wrappers and you go into that unit trust. Let's say skeleton balance 70, for example, because that's still my favorite chart. So if you invest in skeleton balance 70 directly, you have to pay tax at your marginal rate. So now we're moving across horizontally the top line. So you do get some exemptions each year. You get an interest rate exemption, and you get a capital gains tax exemption that applies to your overall portfolio. So if you sold property, or if you have money in the bank, or whatever it is, that's an overall exemption which applies, and that also applies to your investment in your trust. But you are looking at being taxed your marginal rate. So it's 45% of income. If you hold that unit trust for at least 3 years, well, that's capital gains tax, but it's still an 18%. The good news is there's no limits. So you can put it all into a global ETF, and you don't have to worry about end of February. You put it in whenever you want to. So if this is what you're doing, there's no February concerns, no global constraints, but you do pay a lot of tax. If you're in this top line, you either go back to the slide, you either of one of these 2 blue lines, depending on how frequently you sell. You want to be in the red line, you want to go into a tax-free savings account. It's the second line here. Tax is 0% on income, 0% on capital gains. No lock-in, you can take profits whenever you want. Unfortunately, there's a limit to how much you can put in. So every February, so coming up 20th of February, you can only put, at the moment, each 36,000 Rand a year. So please take advantage of that. If you haven't invested your 36,000 Rand for this past year, invest in a tax-free savings account. You can do it through a number of Sygnia products. You just can't use products with performance fees. So any of the non-performance fee classes, there's no restriction on global, so you can go fully into a global ETF or global unit trust. That's available. A local unit trust if you want to, but no restrictions from a global perspective. So make sure that you are taking advantage of this amazing tax saving that the government is giving us, and boost that. Your next best tax friendly vehicle is your retirement annuity. So that you can also then invest in skeleton balance 70. And again, while the portfolio is growing, so up to the age of 55, there's a 0% tax on income and capital gains, and you paid out of your salary or your income. It comes out of your gross income, so you actually can get money back from SARS depending on your overall situation. So that is very attractive. The downside is you're locked into retirement. There's a retirement annuity, so you can't access that money until age 55, but it does come out of your gross salary, and it does grow without paying any tax on that growth. But it's, again, limited. So at the end of February, you need to make sure that you've either maxed your contributions at 27.5% of your income, or 350,000 Rand, whichever is the lower of the two is what you're allowed to do. Of course, there is the global limit, or well aware of Regulation 28, which applies to retirement annuities, and that means you can't have more than 30% global plus 10% Africa. Then you have endowments and living annuities. So those are quite similar, but also different. An endowment is pre-retirement, living annuities are post-retirement. Endowment is useful if you're being taxed your marginal tax rate, because it has tax which is lower. So it's at 45%, it's got 30% on income, it's at 18% on capital gains, it's 12. There's a 5-year lock-in, and there is also a global limit. Living annuities, similarly, here this is post-retirement, but you don't pay any tax, but you can't access any of the money. You can only get a drawdown post-retirement, depending on and that drawdown level can vary from 2.5% to 17.5%, but that's a post-retirement product. But both of those are limited, as you're all well aware from the webinars, to 30%, not because of Regulation 28, but because of SARB limits, which they then put onto life companies, and those both being life policies. Sygnia Life is limited to how much they can offer, and that's why there are constraints to how much exposure you can get. So you do have global limits on those two asset classes. So the bottom two are a bit more complex, and I certainly recommend you talk to your financial advisor about them. But taking advantage of your tax-free savings account, there seems to be no downside to it at all. In a retirement annuity, saving for retirement is vitally important. I can't stress that enough. Making sure you have enough money to retire on. If you have enough to retire, you can retire early. You can retire at 55 instead of whatever that may be. So taking advantage of the tax savings here to get to an earlier retirement, definitely something that you should be looking at. Then the last slide on this, just to take it, if you are looking to top up your tax-free savings account, your retirement annuities, then you are looking for a low risk asset. So as I said, our base case is to overweight equities this year. If you're looking for income, if you're looking for somewhere safe to park your savings in 2022, our zero management fee campaign has been extended. So it's been extended to the end of 2022. Last extension, I promise, last closing down sale. It has been extended to the end of this year. That means if you are currently invested in the Sygnia Money Market Fund, or if you are currently invested in the Sygnia All Bond Index Fund, you continue to pay zero fees until the end of this year. But if you're a new investor, and you come in this year into the Money Market Fund or All Bond Fund, you also participate in zero fees until the end of this year. So we've opened it up to anybody. Even if you invest in December this year, you get 1 month zero fees, and then everyone from 2023 starts to pay fees on these portfolios, and they are fantastic portfolios. I mean, the money market unit trust compared to bank account, 4.7%. That's a lot better than you'll get from any overnight bank account. Yes, you do get term facilities where the banks lock you in for 6 months, and then you think things are quite attractive. But if you want your money accessible tomorrow or the next day, then you can't beat a money market unit trust. Likewise, if you're looking for income and you can afford a bit of volatility, 9.5% on the all bond index fund. That's just a phenomenal yield, nearly 10% a year. Yes, there is some volatility that you do put some of your capital at risk. So you need a slightly longer term time horizon than in cash, but you're getting double the yield. So if you can afford a bit of that, or at least a mixture of the two, we've got most of our clients in a mixture of the two, then that gives you a boost to your yield and only adding a little bit more volatility. But those portfolios are still available for the rest of 2022 at 0 fees. Okay, that is a wrap. Let's look at some questions. Dennis asked me to give an opinion on the Satrix China Fund. Dennis, I don't actually know much about the Satrix China Fund. I think if you tune in on Thursday, I think it's 11 a.m. To Nikki's webinar on our China Fund, you can find out a lot more about our China Fund. We've particularly situated our fund. It is a passive low-cost fund, but it is not based on the broad index. We're focusing on particular sectors that we think will benefit from China's 14 5-year plan, the strategic plan, basically backing sectors that the Chinese economy is, sorry, the Chinese government is backing. But that gives us the benefit of being low cost because it's passive, but also focused not on the broad index, but on sectors that we think will grow ahead of the index. So again, all part of our thematic satellite concepts, low cost, high growth areas. Jaco has a question on whether we think that stocks are going to collapse and whether a stock market collapse is underway. I don't think so. There's certainly very limited chance at the moment of a recession. And without a recession, then this is just likely to another pullback. Now, pullbacks of 5% happen every year, and this at the moment the pullback in dollars at least is just over 5%. Pullbacks of 10% are less frequent, but still quite frequent. You only start to enter a bear market when you hit 20%, and I don't think we're going to get to those levels. So I'm not saying it's not impossible. Market collapses can actually fuel economic collapses. So there's all sorts of things that can happen. But our base case is certainly that this is more of a buying opportunity than a selling opportunity. I don't know if we're at the bottom yet, so I'm not saying this is the bottom, but I also don't firmly believe that this is not the beginning of the end, that we will see a bounce and markets will end the year higher. So I don't think you should panic. I suppose that my bottom line is don't panic. We don't think this is the beginning of the end. A collapse in stocks is not the end of the world. Is not here. Yeah, I do think there's the volatility in the tech. Sorry, just continuing Jaco's question. Volatility in the tech sector or growth sector, particularly innovation stocks, will continue. It all depends on how high US interest rates can go in terms of how much further that volatility can run. But at some point, it will also hit valuation concerns. At some point, it gets cheap enough where the volatility becomes self-defeating. So we are looking to increase our exposure to fourth IR, not cut it. We haven't done so yet. So I'm not saying that we're at the bottom, but I think that we're looking at getting closer to a buying opportunity, not a selling opportunity. Christina, the FANG ETF was the bottom line on the first slide. It was the best performer last year. The only thing that did better than FANG stocks last year was oil. That was one of the thematic themes that did very well. Johan has a question on the Sygnia Global Income Fund. It's not currently available on the Alchemy platform, and we're busy putting together access and marketing sheets on that. So this is talking to our Irish funds. So we do have 3 Irish funds that are available, very, very exciting. So we've got our Global Income Fund, we've got the Fourth Industrial Revolution Fund, which is identical, but it's a dollar-based version, or very similar, but it's a dollar-based version. And we've got our Health Innovation Fund, a dollar-based version. We're in the process, we've already registered with the Irish Central Bank to launch our China Fund on the dollar platform, and our new Sustainable Technology Fund, which is going to be a subset of Fourth Industrial Revolution, also quite exciting. Those will all be available on through our Irish unit trusts, our dollar-based unit trusts. More information of that should be coming very, very, very soon. And we should have fact sheets and more details on how to access that very soon. So I'll make sure that that gets out soon, Johan. Wayne has a question. So Wayne, I don't believe SA bond yields are going to rise. US bond yields are going to rise, and that does you right. When US bond yields rise, that tends to feed through to SA bond yields rise. As I said, US bond yields are the most important asset class in the entire world. Everything is based on that. You have US bond yields, and you have some sort of risk premium. You have SA bond yields, and you have equities which are based off those discount rates. But there's so much risk priced in, there's such a buffer priced into SA bonds that even when US bonds rise, as we've seen has happened over the last 2 months, US bond yields have risen to new highs, and South African bond yields are actually stronger. And that's just because you're seeing a risk on appetite, which means foreigners are buying bonds, and that risk premium is absorbing all the increase in US yields. So despite, again, economics saying US bond yields result in SA bond yields rising, you have the reverse, because investors often run ahead of economics, or they buy the rumor and sell the fact, whatever it may be. SA bond yields are falling. Which is good for SA bonds, and it's very good for bond funds. And also good for income maximizer, which has still got a decent chunk of bonds in it. The Sygnia Enhanced Income Fund doesn't have any bonds in it. It's only got credit. So that fund has still got a relatively low yield, or much better than cash, but I think compared to bonds, it's about 6.5%, 6.7%. That yield should increase as South African interest rates rise. So we are predicting South African interest rates to rise to at least another 0.5% this year, maybe more, and that will then push the yield on Enhanced Income Fund over 7%. And then at some point, you'll want to rotate out of South African bonds into Enhanced Income when that yield differentiation shrinks, but we're not there yet. Johan, best way to invest in global value, if you want to do it through the Sygnia platform, is as I said, the iTrix Sygnia UK FTSE 100 index. SA value, we've got our Divi fund. Again, the Divi fund, we've got the existing Class A, which has a low passive fee. We also have the new Class B, which has a 0% management fee, and that's forever, with a performance fee if value outperforms the general index. So if you want value in South Africa, we've got the Divi Unit Trust, very exciting. Where else can you get an equity fund? 0 fees, 0 management fee, only a performance fee if the fund outperforms. So if you're looking for value in South Africa, that is, I can't think of a better opportunity. Christopher asks about Chinese GDP. Yeah, you spot on, Christopher. So this is around the 14th Chinese 5-year plan. Since the 12th Chinese 5-year plan, China has been very strongly focused on rotating away from manufacturing towards quality and domestic consumption. It is taking longer than they'd like, because every time there's a crisis, they have to support the economy with property, which results in stronger manufacturing and supports the old economy sectors. But they are, as we've seen with reforms over the last year, they are very, very much focused on that. And we are likely to see much more focused support coming through in only the sectors that they want to support. So I do think that they are becoming a lot more targeted in their and successful in their ability to target only particular sectors. So I think that they will be able to target consumer-oriented economy, and certainly the growth that's coming through out of China over the last 10 years. The highest growth sector has been the tertiary sector, which is services, and manufacturing has fallen in its size to the point where the tertiary sector is now the largest sector in China. So it's happened over the last 10 years. It continues to happen. Yes, manufacturing is still a big part of the Chinese economy, but it's decreasing. And again, Nikki will show you on Thursday that the best performance from an investment perspective has not been in the old sectors, even though it still is a big part of their GDP. Stuart says SA not delivering in 2022, and yet the JSE has reached historic highs. We're spot on, but it talks to divergence of what happens underlying our broad indices. That reaching new highs has been driven by Richmond, has been driven by resource companies. It hasn't been driven by SA Inc. Retailers, banks still are below their pre-COVID highs. Anything that's linked to South African economy has vastly struggled, and that's obviously where all the value lies. I mean, they're looking particularly cheap, strong dividend yields, and earnings actually aren't too bad, but those aren't the sectors that are driving SA to new highs. It's the 70% of top 40 earnings are offshore based, and that's what's taken SA to new highs. So we are lucky in that our South African stock market is well diversified and does have a lot of global earnings in it, dollar-based earnings. So when South Africa is failing to deliver, that our retirement savings aren't hurt as much, and that's why it's still good to have South African equities. But you get more diversification. You get very limited global exposure within South Africa. You get more diversified if you go direct. EJ asked a question about interest rates rising, still being overweight equities. Yes, certainly in the early part of the interest rate hiking cycle, you want to be overweight equities. Generally, interest rates are only hiked when growth is strong. When growth is strong, equities tend to do well. Not as well as they have did in the previous part of the cycle, but they still are positive and still good to overweight equities. Dwayne asked a question about tax, which unfortunately I can't answer. Thanks, Dwayne. Lisa asks about whether there will be changes in the budget on tax allowances. It's a very good question, Lisa. We'll wait and see what happens. Certainly, one of the things we are hoping is that SARB allows us more than 30% offshore. It's something we keep looking for and asking for, but we'll be watching that quite closely in the February budget. The budget is a risk. So while we're overweight bonds, the biggest risk to that position is a budget where expenditure is increased a lot more than we'd like, either to fund extension to the social distress relief grant or to pay for higher wage settlements. I don't think it's not a base case. The National Treasury has been very, very conservative so far, but it is a risk. And to answer Nicholas' question, yeah, if you look at the benchmarks, the benchmark is roughly on a global equity perspective is roughly 80% MSCI All Country World is the global equity benchmark, and that's roughly 80% developed market, 15% emerging markets. And we are starting from that benchmark, we are then overweight emerging markets, and we're overweight Europe, and we're overweight Japan. We're also overweight value. Now that value gives us a bit more of exposure to UK and other value regions and other value sectors, but that is a secondary impact of those positions. Rich asked a proverbial question, which there's always no answer to. Your view on the Rand dollar. So the Rand dollar has strengthened very nicely, back down to 15.10 this morning. 15.07 it reached on Friday. That is compared to what's happening in other emerging markets like Turkey, that has certainly had an incredibly strong run. Our view for a while has been that roughly 14.50 was the fair value at the end of last year, maybe 14.80, and we're looking at a fair value of 14.5 at the end of this year. So we think that we're roughly in the fair value range now of 15, and we think it probably will trade in this range. Might break down below 15 slightly, but it's likely to end the year at 15.5. It all depends on global events. It all depends on what happens to the dollar. We think the dollar will be a tailwind to the Rand with the dollar weakening. But the South African budget could be an issue, or an emerging markets could be an issue. But in general, we think EMs will be positive this year, which again is positive for the Rand. Commodities are stable-ish. We do think they'll come off a bit, which will be a headwind to the Rand. But yeah, our point estimate is 14.5 at the end of this year. Yash asks about expected returns for various asset classes. Again, we don't really have a one-year number, but all I can say is we're overweight equities, underweight bonds, underweight cash. So that implies our direction. So we have a direction for returns, and that's more important than an absolute number. Right now, we do think the Rand could continue to strengthen a bit more. We do think equities will go up from here, not down. But that's the direction, not a point estimate. And that's how we take advantage of our taxable asset allocation. It's important to always know what that direction is going to be, being positioned for that direction and taking profits at the appropriate time. Natalie asked a question: when does 4th bottom out and recover the 2020 levels? 4th has bottomed out relative to the S&P 500 already. So if you plot a relative chart to S&P 500, 4th had a huge, 4th Industrial Revolution Fund had a huge premium in 2020 because of COVID and low interest rates and innovation premium. That is completely unwound. So if you look at 2018 levels and 2019 levels on a price basis, 4th is now trading back at those similar price ratios. So that full premium has been removed, and that's why we think that's why we're looking at getting involved in 4th again, because of the reduction, that removal of that premium altogether. And we do believe that there should be a small premium for those growth stocks. However, on the other hand, when you've got US interest rates rising, there are headwinds, and in the short term there could be a small discount. So that's I think we're sitting at an equilibrium fair value right now, and it's whether the macro factors force a small discount if it happens, or whether it's not worth risking that happens and buying sick. So that's what we're busy weighing on. Longer term, yes, we fully believe that growth and quality will outperform value. It's because we're on a low return environment, and value only really does well cyclically when the growth is very strong, and particularly when interest rates are rising, because that's when growth is very, very strong. Andrew asked about OSI. The OSI newsletter should be out within the next few days, and that should have more information than I can tell you right now about what's happening in the fund, the exciting things that are happening in that fund, and the outlook for the rest of the year. So please keep an eye on your mails. There should be a mailer on the OSI fund shortly. Carl asked about our view on FANG. We still don't have any additional FANG in our portfolios. Obviously, FANG makes a big portion of S&P 500, which is more than half of our equity portfolios. We've got ample exposure to Apple, Amazon, Netflix, and the other FANG stocks. We don't have any specific FANG holding because we have S&P 500 holding. And we are still concerned about some of the valuations there and antitrust issues. That said, they've come back nicely in January, but I think there still could be some volatility ahead. And that's why we don't have any additional FANG in our portfolios at the moment. FTSE, yeah, Matthew confirming the FTSE 100 is the portfolio that has 40% of it being value stocks, only 1% of its constituents being tech stocks. Bradley, great question on Sygnia crypto ETF. So we are launching a crypto ETF. It is not going to be Bitcoin because that's not allowed. The regulator won't allow us to launch a Bitcoin ETF. And there's definitely debatable whether you want a Bitcoin ETF. What we are launching is a distributed ledger, which basically looks at the technology behind Bitcoin. And there's no disagreement that that technology is going to change the way that everything happens, from inventory to banking to online data storage. That technology is vastly important. So we are launching a distributed ledger ETF, and that should happen in the first half of this year, and there will be more information on that. So please look out for that. We are excited about that. But that we think is probably the best long-term position, and it's also what is allowed by the regulators within South Africa. So, and it's also less volatile. So it's probably a better place to invest, at least to take advantage of the technology, if not the actual coins themselves. Christian asked about LAs. As I mentioned, the Sygnia Life has a cap of 30%. Please, I'm still waiting for a broad discussion that we can announcement, but that is not possible yet. So please email Sher, and who's on the webinar invite, and she'll put you through to retail, and they will assist you with working out exactly what those levels are, and if there is any way to help. And that's it for me for today. Sure, long session. Thank you very much to everybody for joining. Thanks for listening. Thanks for staying till the end. All the best for February. Yeah, I'll talk to you at the beginning of March. Have a great day. Cheers.